Welcome, everyone. I'm Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Today's session, PreVC investment stage. Can you obtain consistent 3 to 5 times X returns? Yes, you heard me, with low risk and low taxes. It features David Lambert, Managing Director of Rightside Capital Management. Now, today's session is going to be a little different. One, it's for our live audience and being privately recorded for members and single family offices only. It will not be up on public distribution platforms. So all the better for those of you that are live. It will be in presentation format, which many of you who are active allocators often prefer. Angelo, you do enough about education. It's all good and valuable, but sometimes we want to hear from smart, talented people that actually have something they're offering so we could listen. So it'll be about 20 or 30 minutes. I'll probably have some questions at the end, and we hope you do as well. It's a great subject. We look forward to it. Dave, how are you?
I'm doing really well. Thanks for having me on.
And really on that note, why don't I give the show to you and look forward to it myself?
Okay, great. I'm going to go ahead and share my screen here quickly. And then I will introduce myself. So my name is David Lambert. I'm one of the founders and managing directors of Rightside Capital. I am presenting today because we're fundraising for our Fund 4, and we're about to have our final close coming up at the end of Q1. I'm going to talk today a bit about our firm, about the very unique pre-VC stage of the entrepreneurial ecosystem that we invest in. And I'm going to explain some of the very unique math and return dynamics at play in this stage and how you can generate extremely high returns with almost no tax liability. So I'm just going to go ahead and jump right into it here. So I'm going to start a little bit about us as a firm. So Rightside Capital Management is the most active pre-VC stage investment firm in the United States. So we're based here in San Francisco, but we do invest all over the country. And in fact, even though we do a lot of investments in the Bay Area and New York, we do a lot more investments outside of those two large geographies into secondary geographies. We have made over 1,100 investments into portfolio companies since 2012. We're very much domain experts and domain leaders at this stage of the market. And before I jump into the nitty-gritty of my presentation, I'm going to give you a little bit of a teaser as to why you would want to consider investing in one of our funds. So to start with, our funds tend to produce 3 to 5x plus returns in almost all macroeconomic environments. Very consistent high returns. They do so with relatively low volatility and relatively low risk. There's very, in order to lose capital in one of our funds, we're at war and being invaded type of situation. And I believe that most people on this presentation don't like to pay taxes if they don't have to. And we are able to generate these 3 to 5x plus returns, not only consistently, but have a close to 0% federal tax rate on the returns, and also in 45 of 50 states. So this is just a quick highlight. I'll go into more depth into each of these topics a little later on in the presentation, but just wanted to try and grab your interest up front here. So here's a bit of the agenda of what I'm going to go over today. So I'm going to talk about the pre-VC market and sort of describe what is it, how is it different than sort of the seed and pre-seed stage, and what are the market dynamics in play at this stage. I'm going to discuss briefly our unique strategy for investing in this market, and then I'm going to describe some of the unique math that comes into play at the pre-VC stage. So you have a very strange distribution of returns at play at this stage, and you have some very unintuitive mathematical outcomes. And I'll talk about how we sort of leverage and exploit those. I'll go a little more into depth into our historical performance of our funds. I'll talk about the tax profile of returns, and then quickly just, team and fund terms, and then we can get into any Q&A that you have. So before I jump into defining the pre-VC market, I'm going to talk a little bit about this multi-decade capital efficiency trend that has enabled this pre-VC market to really explode onto the scene in the 2010s. And this trend is a capital efficiency trend that has to do with the cost to build the first version of your software product and how it's just constantly gone down over time. So if you look at the chart on the right, you'll see that the blue line represents the cost to build a really functional beta version of your software product that has enough features and functionality that you can take it to market and really prove or disprove if you can sell your product. Will the market buy it? And if you look in the mid 1980s, it actually cost $20 to $25 million to build a software product and take it to market. And by the time you got to the early 2000s, it had dropped to the low single-digit millions of dollars. And boy, at the time, let me tell you, we thought that was so cheap and inexpensive. We couldn't believe it. But the reality is we were just on this steady trend line downwards. And by the time we hit 2010, it was down to about $1 million on average to build an initial software product for most software companies. And this was a key inflection point because this really launched the micro VC market that we're also familiar with that's emerged in this last decade. So by the late 2000s, the venture capital world had some consolidation and fund sizes had started to get larger. And according to the NVCA, the average seed round was a $4 million plus round. But yet you had all these companies that could now build products with much less capital. And so you had some forward-looking fund managers who thought to themselves, I can do venture capital much more quickly and with smaller dollars. And if I do that, there'll be this huge demand for my capital and I won't have a lot of competition that's deploying it. And they were completely correct. That strategy worked really well for a handful of years. And as we all know, over this past decade, that market's become an incredibly crowded market now because the barrier to entry is relatively low. Well, if we look at this capital efficiency trend, it turns out that it didn't just continue into the 2010s, it actually accelerated in the 2010s. So this next chart that I'm going to show you is the cost to build your first software product from 2010 to the end of 2016. And it actually dropped by another 90%, which is just incredible. So by the time we get to 2016, 2017 timeframe, the average company can build a software product with only $100,000. Now, some products and some profile of teams take a little more than that, but some profiles take zero if you're just 2 or 3 technical founders and you can do it on your own. And this was another key inflection point. Around this time, we began to see this new wave of capital efficient startups coming onto the scene all across the country and North America. And this really caused the pre-VC stage of the market to take off. So what I'm going to do now on this next slide, let me talk a little bit about what is this pre-VC stage market and how is it different. So for the most part, this pre-VC stage is defined by companies that are looking for very small funding rounds. So these are not the $1 million to $2 million seed rounds that are happening these days. These are companies looking for $200,000, $300,000 of total funding. They are round sizes that are generally too small for even seed and pre-seed VCs to address. And in the first half of the last decade, if you had a company that was looking to raise just a few $100,000, it was almost a guarantee that they were pre-revenue and still working on their prototype. But by the time we got to the later part of this decade, the cream of the crop were companies that had live products with paying customers and real revenue. And they still were just looking for a few $100,000. And what we've seen is that there are more and more of these companies every year. Demand for capital is just steadily increasing at this stage. And the big challenge is that the investor world hasn't had the same response as it did in 2010. There wasn't this key inflection point where there was a big change in behavior on the investor side of the fence. And the reason why is that check sizes are substantially too small at this stage to support the venture capital model. So the VC model is a very labor-intensive model, and it doesn't really work out well if you have to spend a lot of time doing diligence on a company, sometimes sit on its board, and then you only invest $100,000. Those unit economics don't even work out for seed and pre-seed stage VCs. And another challenge at this stage is that investments are extremely risky. So they're much riskier and a much greater chance of going to zero than at the seed stage. And if you're just going to build a portfolio of 20 to 30 pre-VC stage investments, you still have a high risk of losing capital. It's more like buying positive EV lottery tickets. But despite those dynamics, it doesn't change the fact that there's just incredible outsized return opportunities at this stage. And there's two reasons why this is the case. The first is that throughout history, as you've invested at earlier stages in the venture capital world, you tend to get higher returns. And that's because earlier stage investments are just more risky. And as a result, the market has to pay a higher risk premium to investors to induce them to invest. And that's definitely true at the pre-VC stage. It's riskier, and as a result, there's a much higher risk premium that the market pays compared to traditional VC stages. But the other key factor is that there's almost no professional competition at this stage. So for the most part, all the funding at this stage is coming from friends, family, credit card debt, investors' own entrepreneurs' own capital, and occasionally, semi-professional angel investors that might exist in those markets. And that makes it a very different dynamic for a professional investor that's investing in that stage. So at Rightside Capital, we've built a completely different model for making investments that is tailored to this pre-VC stage. And we don't do what traditional venture capital firms do. So I've ran companies in the technology world for almost 2 decades. I've been an investor for decades, but we don't use my gut feel and my subjective analysis to pick companies. Instead, we've built this quantitative data-driven investment process where we suck up a few dozen data points about a company, and then we make an investment decision based on that real world data rather than on gut feel. And one of the key things that this allows us to do is allows us to reduce our investment decision time by over 95%. And this allows us to do a couple things. The first thing it allows us to do is give entrepreneurs an incredibly fast, transparent funding process. So if you go to our website, rightsidecapital.com, you can see that we lay out for everyone to see exactly what we're looking for in companies. We have a relatively narrow target investment profile, and we just say exactly what it is. And when we look at companies and gather up data, we can give them an investment decision in days. That's a firm yes or no, whereas most investors will take months to make a decision. And so we save entrepreneurs 4 to 6 months of highly distracted fundraising time, and they're willing to compensate us for doing that. In general, we get valuations that are 20 to 30% below what anyone else is able to get in return for providing this product to entrepreneurs. The other thing that this quantitative data-driven selection process allows us to do, in addition to just identifying profiles of companies that outperform, because we can make quick decisions, we can build really large portfolios. And each of our funds doesn't just have tens of investments in it, it has hundreds of portfolio companies. So to give some perspective, our most recent fund, our Fund 3, had over 600 portfolio companies in it. And we do this for a few different reasons, but ultimately it's about locking in high returns and mitigating downside risk. And I'll talk a little bit about that math just a little later in the presentation. So for now, I just want to sort of give the quick overview, and I've just sort of scratched the surface of our investment strategy and what we do, but we've got limited time today. Happy to address it more in Q&A or one-on-one with people that follow up. But at the high level, we're targeting this pre-VC stage of the tech ecosystem. This is a segment where check sizes are too small for traditional venture capital firms, even seed stage firms to address. And there's huge demand there. And we get to invest in that stage without having any other professional competition. We are domain experts at this stage. We have a huge sort of asymmetric data advantage because this is all we do is this stage. And we're able to exploit a lot of the efficiencies in this market to get much better deals than other people get. If any of you that are listening are direct investors, you'll probably know that it's been years since you saw many companies with significant revenue at $3 million valuations or lower. Yet at Rightside Capital, almost all of our investments are done at $2 to $3 million valuation ranges, and most of them have anywhere from 5,000 to 25,000 of MRR at the time that we invest. So we really just do get deals that other people don't see. And we're able to do this in a manner that optimizes for tax efficiency. So at the end of the day, the goal is 3 to 5x plus returns, very low risk, very little, if any, tax liability. So obviously that's an attractive goal, but I'm going to jump now to another topic, which is a little more interesting, which has to do with the strange math that's in play at the segment of the market in which we focus. So I'm going to start to give you a little perspective by looking at the math that's in play for public stocks, and then I'll drop down to our segment. So when you invest in public stocks, each individual stock has a log normal return distribution as far as where its return can come. So if you invest in 10, 20 different stocks, there's going to be a pretty high variance in the returns of those stocks, but not crazily high variance. You're not going to have some stock that is a 1000x winner if you're investing in large cap stocks. And at this stage of investing, all the traditional assumptions about variance and expected returns hold. So there are benefits to diversification. If you invest in 1, 5, 20, or 100 stocks, your expected return is pretty much the same, but your variance gets lower as you increase the size of your portfolio. But beyond some point, and for large cap stocks, it's in that 20 to 30 range, as long as you're selecting stocks that are fairly uncorrelated business models, the benefits of diversification diminish and go almost to zero. Now, if we go down one next level and we look at mid to late stage VC investments, their distribution of returns falls along a power law distribution instead of a log normal return distribution. And it has a shape parameter around 4. You don't even have to understand what that means, but I'll touch on that a little later. And at this stage of investing, most of the conventional thinking about variance and returns works, although it breaks down at some of the extremes, but it still generally holds for the purposes of portfolio planning. So in general, if you increase the number of investments that you make, you are lowering the variance of your return, but your expected return stays the same. And there are benefits of diversification up to much larger numbers, but at some points, that extra added benefit gets very, very small. Now let's look at the pre-VC stage, and this is where things start to get a little interesting. Pre-VC stage of investing, the distribution falls in what's called a highly skewed power law distribution, and the shape parameter is below 2. And you don't even have to understand what that means, but here are the implications. Conventional thinking about variance and returns just breaks down with this type of a distribution. And what happens is when you have a shape parameter below 3, you get what's called unbounded variance. And I'm going to describe what that is in the next slide. And when you get below 2, you don't just have unbounded variance, you have an unbounded mean. So let me talk about what that means as far as real world implications. So when you have unbounded variance, it means there is no limit to the benefits of diversification. Additional diversification always improves your risk-adjusted return with unbounded variance. So that's, I think, pretty intuitive, and you can understand why that might be the case. Here's where it starts to get unintuitive. What's an unbounded mean mean? It means that the average return is unbounded and thus incalculable. And why is this the case? This is the case because you have a situation where a single investment can potentially have an almost unlimited return. And I'll give a quick example of what investment like that might look like. If you take Andy Bechtolsheim, who is the founder of Sun, he wrote the first $100,000 check into Google, and he did it before they even incorporated. And that $100,000 turned into over $1 billion. There's a greater than 10,000x return. So when you have a distribution return that curve that has huge outliers like that on it, you get some unusual and unintuitive math outcomes. And here's one of them that's incredibly unintuitive. A larger portfolio doesn't just reduce variance anymore. A larger portfolio actually has a higher expected return than a smaller one. So think about that for a minute. It's incredibly unintuitive. But it means that if you make the exact same profile bet and you do it 100 times instead of 10 times, you actually have a higher expected return when you do it 100 times. And think how odd that is. If I give you the chance to bet on a coin toss and I give you 2-to-1 odds if you win, you're going to have a 50% positive EV on your bet. And whether I let you bet 1 time, 100 times, or 1,000,000 times, your expected return is just 50%. More bets doesn't change your EV. But the math at the world that we play at just works differently, and more bets does increase your return. So now let's look at what happens when you take the vast sort of domain expertise that we have and this asymmetric data advantage and this very unique investment model, and then you mix that with our really strong understanding of this unusual math and what drives returns. Well, here are the results that you get. Our Fund 1 launched in 2012, and to date, we have almost a 3.7 net return on invested capital to investors. So $1 invested in our fund is now worth 3.65x. We're trending towards a final return of 5x plus of invested capital back to investors, and our fund's going to wind up in only a few years. And we've already returned 176% of invested capital back to investors. So if you're a $1 million investor in our Fund 1, you've already received back $1.75 million. You've got almost another $2 million in play. And the great part is it's been almost entirely tax-free. And I say almost entirely tax-free because our Fund 1 has actually been better than tax-free. Our Fund 1 currently has a net negative tax rate to our investors. So that means not only have we returned 1.75 million back to you, but the federal government has also kicked in some extra tax credits as sort of some icing on top of that cake. Our Fund 2, which we launched in 2015, is trending ahead of where Fund 1 was at the same point in its life cycle. And if you remember back to my earlier presentation where I talked about that key inflection point that happened in 2016, where we had sort of a different profile of pre-seed stage startups that were coming on the scene, well, investment fundamentals got a lot better at that point in time. And our Fund 3 launched in 2017. So our Fund 3 got to invest almost exclusively in even a more attractive sort of investment fundamentals profile than our previous funds. And our Fund 3 is crushing our Funds 1 and 2 at the same point in its life cycle. So let me now show you a chart so you can visualize some of this performance. This chart shows the TVPI history of each of our funds over time. So TVPI stands for total value to paid in capital. And what it means very simply is what is $1 invested into our fund worth now, or at any point in time in history, when you combine both the capital we've returned back to investors and what they have left in our fund. And if you look at that blue line, that's our Fund 1. $1 in has turned into almost 3.7x back. We have an almost 20% compounded IRR over a 9-year period, and it's almost entirely tax-free. Our Fund 2, which is that orange line, is treading almost identically to Fund 1, but slightly ahead of it by about 6 months. And you can even see it's starting to slope up at almost the exact same point in time. And our Fund 3 is handily crushing our Fund 1 and Fund 2. It's basically moving up, but is about 1 to 3 years ahead of where they are in the same point of their life cycle. So here are some notable exits we've had in our funds. You'll see what we effectively do with our very diversified portfolios is we capture the right end of that return curve, that tail, with very high certainty. And one of the things that's very notable about what our funds do is that because we invest at such low valuations, we are able to generate crazy return multiples at below unicorn exit valuations. So if you look at that top company, TradingView, we were able to sell half of our position in a secondary sale last year, and we got a 123x return on that sale, and it was only a $640 million exit valuation. It was closer to $500 million than it was to being a unicorn. PillPack, another example, acquired by Amazon for a sub-billion-dollar valuation, but it was an 80x return. So we very consistently capture these returns, and we don't even need unicorns to get them. Unicorns are complete icing on our cake. What I want to touch upon now is a brief touch on the tax efficiency aspects of our fund. So I could give an entire presentation on this, but what I'm going to do is just touch briefly on the 2 aspects of the IRS tax code that we take advantage of. So the first is section 1202. This has to do with qualified small business stock gains, QSBS gains. And I'm sure some of you have heard of this. And what this section states is that if you invest in the stock of a C Corp that is a qualified small business, and almost every company we invest in is, And if you hold that stock for over 5 years, your returns are going to be tax-free federally. And 45 of 50 states also recognize that as tax-free, New York being one of them. California, where I am, unfortunately, is not. It's in the bucket of 5 that doesn't. Another section of the tax code that we are able to take advantage of is section 1244. Very few people have heard of this. This section is geared just towards extremely early investors like us. If you are part of the first $1 million into a QSB company and your investment loses money, you can deduct that investment loss as an ordinary loss instead of a capital loss. It's actually deductible against income. And this passes straight through our funds to all of our individual LPs. And if you're investing in an LLC, it passes straight through that LLC to the ultimate beneficiaries of that LLC. So when you combine our gains, which are primarily tax-free, our losses, which get deducted as income, and then some gains in between, which are long-term gains and a little bit of interest income, you end up with a blended tax rate that is close to 0. And as you can see from our Fund 1, it can sometimes even be negative. So I'm almost done here. Let me just touch very quickly on the management team. There are 3 managing directors. My background is that I am a career entrepreneur. I spent about 2 decades being the CEO and founder of 2 technology startups. One was a hardware company, one was a software company. I was an angel investor on and off from the mid-90s to the mid-2000s, and then helped launch Rightside Capital at the end of the 2000s. I went to undergraduate at Stanford, where I met one of my other partners, Kevin Dick. Kevin is one of those people that is a quant and sort of dreams math and math models in his sleep. He's got a lot of patents, mostly in the network security space. He was relatively famous in the late 90s in the database and software services world, which became the cloud world. He's founded a number of startups and has both an undergrad and graduate degree from Stanford. Our third partner, Jeff Pomeranz. I met Jeff because my oldest kid went to elementary school with his kid, and we met on the kindergarten playground. He is a career entrepreneur in the financial services sector, started a boutique investment bank brokerage firm that operated here in San Francisco in the 90s and early 2000s. And my last slide is just a quick data point about our Fund 4, which we're currently raising for. We're having our final close at the end of Q1 of this quarter. We're going to be investing through mid-2023. We've already invested in 150 companies in the last year. We do semi-annual capital calls, pretty standard returns. The one thing that I should note is different for us, we're one of the few venture firms in the country that actually offers a preferred cumulative hurdle return to investors. The norm in the VC industry is no preferred return. But our philosophy is that we're going to market that we produce these really high returns in all macroeconomic environments. If we're going to do that, we better walk the walk in addition to just talking the talk. And so we do that. So that's the end of my presentation. Happy to take any questions you might have, and happy to also speak with any of you directly if you want to follow up with me afterwards. I've listed my email and my direct cell number there on the page.
Great. That was literally fantastic, Dave. It was incredibly impressive. I do have some questions, but I am first going to go to the audience where a couple of questions came in. We encourage you to send in more questions via the chat feature because some people will be listening to this, again, as a private recording for members and SFOs only, but not up on our public platforms. I will read the questions out because, again, if they're listening or even perhaps watching it, they're not going to see the chat feature aspect of it. So why don't I go first to the audience questions? And that would be, Dave, when do you typically exit a position?
Okay, that's a great question. So when we launched in 2012, our assumption is that we would generally exit positions when the company has had exits. But one of the great trends that's taken place in the 2000s and 10s is that the venture capital world, sort of the mid and late stages, has gotten incredibly overcapitalized. And that's resulted in this huge and robust secondary market that exists. So, we have sort of 3 sources of exits. The most common is, M&A activity. We get a lot of small value M&A exits, and we can get exits, at 40, 50 million and still get 8x returns pretty easily. We have a lot of later stage M&A activity that happens. We have a handful of companies that could go public at any time. But one of the more interesting things is that we're able to get a lot of secondary liquidity now. So that TradingView exit that we did, we were able to sell half our position in June of last year when the pandemic was still, going strong. And, here we're on solid lockdown, and we were able to return our entire fund in June off of a secondary transaction. I would say in our fund one, we get, a dozen inbound inquiries every month of people looking to buy our positions from us. And even though we're technically an illiquid fund, we could sell 70% of our fund one in about 3 months to secondary buyers just from inbound interest. So there's a lot of different exit opportunities.
Excellent. Another question. Does the larger number of investments result in a higher expected return because you are more likely to have an outsized home run that dominates the return?
Yes, so that's true. That's the right way to think about it. What actually happens is there's almost an unlimited potential return out there. And so even if you have some pool of 100 or 1,000 or 10,000 investments that you're aware of, and you think you know what the highest potential expected, possible return is, there always exists a higher one. So the more investments you make, the more chances you have of getting an outlier that's never been seen before. And this type of distribution happens in nature too. That's true also with the size of moon craters and with solar flares, things like that. But at the end of the day, Andy Bechtolsheim's 10,000x plus return, and just because that's there doesn't, and that's maybe the largest one we know about, doesn't mean a 100,000x return isn't possible.
And more questions coming in. Of course, something special for Family Office Association members. What is the minimum investment amount?
Our minimum investment amount is $500,000. Where we are in our fund, in our life cycle right now for the fund, is we've already called 40% of capital from our fund 4. So if you commit now, you're going to immediately get a catch-up capital call for 40% of capital. And then the remaining 60% is going to be called over in 4 capital calls of 15% each. The next one will be probably the middle of this year, and then one every 6 months from that point forward.
What time period are the historical exit multiples returns based on?
So I'm not quite sure what you mean there. I'll give a couple answers. Our fund 1 invested from 2012 to 2015. Our fund 2 was deploying capital from 2015 through 2017. And our fund 3 launched in the last half of 2017 and deployed capital from then up until into the Q1 of 2020.
Another question.
Yeah,
continue.
That question might have also been asking, how long does it take to generate the return multiples? So in general, the way our funds work is that capital flows into the funds for the first 3 years. You can have a return then. In our fund 1, we actually distributed some capital back out in year 3 while we were still making capital calls. In general, in the next few years after that, there will be some small distributions, but nothing significant. And then the majority of distributions are going to happen in years 8 through 12 when we'll wind up the fund and distribute all remaining capital back to the LPs. We actually sort of want delayed liquidity because that hold period of over 5 years is what allows us to recognize these returns tax-free and pass that tax-free recognition through to our LPs.
Do you track the percentage of female-founded companies in your portfolio?
So we do not, right? We're actually in the process of going back and doing that. So interestingly, we have never had one of our screens be anything about the sex or race of our founders. And what's interesting is because of that, we have a disproportionately large number of both female founders and minority founders. And the reason for this is that we use a quantitative screen that only looks at real world numbers, such as traction, growth curve, capital efficiency. And if the rest of the investor world tends to have a bias against minority founders and female founders, that means they're going to score higher on the things that we look for. Those companies are going to tend to have higher traction levels relative to the valuations we get, and we're going to just naturally end up investing in a lot more. So we know that we have a much higher percentage of minority and female founders, but we don't have that data in our database yet. So we're actually having one of our data analysts do a project right now. We're probably a few months away from having that across all of them.
You take a quantitative approach in terms of at least analyzing the opportunity, how are you sourcing deal flow? You're investing in so many different companies. I don't know if it's coming at you like a fire hose where there's tens of thousands every year, or you belong to certain services, have filters. What's your secret?
Yeah, we do a few different things. So we deploy capital in two ways. One is we do a ton of direct investments. The other way is we actually have minority ownership interest in some different startup accelerator organizations where we get a small piece of every company going through, and a few other startup accelerators where we're the capital behind them and we get a piece of every company going through. But on the direct side, we get deals from almost every way you can imagine. We have 2,000 founders of our existing companies that are scouts on the ground. They're constantly sending us stuff. We have a huge network of next round funders, whether it's angel investors, seed stage VCs, regular VCs, corporates, family offices. They're all sending us deals that are too early for them. A lot of our investors send us deals. We get a massive amount of random inbound deal flow, just emails and people filling out our form online. Regardless of where you come from, every company has an equal chance of getting funded. So we don't have any bias towards companies that come to us sort of in network. What's interesting is that at our stage, I mentioned we have no professional competition. Our biggest challenge is always that we're capital constrained at any point in time. We always have more attractive deals to invest in than we have capital to deploy. And I know that once you get to the seed stage of the venture capital world, that dynamic flips. The challenge is finding attractive deals. For us, that's sort of item number 6 on our plate. It's just not something we struggle with.
And if you're analyzing those that have been successful, you're going to lean towards being quantitative, but a little bit of your qualitative feel, a little bit of art and science. We have a lot of people that have children that are entrepreneurs. Everyone is interested in entrepreneurship and starting companies. From your experience, having seen so many, and those that have worked and haven't worked, and yes, luck and timing and a variety of factors that no one has control over do play into it. But what are certain traits that you tend to see?
So the thing that that's one of the most important factors at the stage that we invest is capital efficiency. And this is sort of counterintuitive. A lot of people don't understand that probably 80% of the value that we're investing in at a company at this point in time is optionality. It's not just the business model and the founding team we're investing in, but it's what that founding team and business model can randomly decide to pivot to and become 6 or 12 months later. And when we invest in companies, the ones that take off, sometimes they take off 2 months after we invest, and sometimes they squiggle sideways for 18 to 24 months. And then they happen, and everything sort of comes together and it just takes off like a rocket ship. But one thing I can tell you with certainty is all of our winners that took off 18 to 24 months later, if they had hit a cash wall and died at month 12 or 14, they'd be a 0 instead of a massive home run.
Wow.
The other thing we find out about that from a psychological perspective is if you have 2 identical companies and the business models look almost the same, but one of those companies has a $60,000 a month cash burn at the time we invest, and one has 15 or 20,000. The founders of that one that has that larger cash burn, they've got blinders on because they're already feeling the pressure of, will I be able to get enough traction so I can raise the next round? And if I don't, I'm going to hit a cash wall pretty hard. The founders of the more capital efficient startup, they're not feeling that pressure because even if things don't go as planned, they can just raise for another $200,000, they can get another year of runway. And so what happens is those founders don't have blinders on, and 3 or 4 months in, they might even be selling and revenue might be going up. But if they all of a sudden, get a lot of feedback from a handful of customers and they discover there's this other product they could build and the revenue potential would be even higher, they'll notice that and they'll think about throwing out their current business model and pivoting to that. And the team with the larger cash burn will just never even notice that. They'll just blow right by that observation.
Interesting insights. And another question I would have, trends you're seeing, whether it's the type of companies or other factors during COVID.
Yeah, so COVID was a very big surprise to us sort of across the board in a number of ways. I'd say the thing we were most impressed with is just the innovation and tenacity across the board amongst entrepreneurs, throughout our portfolio. It's just amazing how quickly companies were able to pivot and adjust, whether it's having to downsize to lower your cash burn, or realizing that your business model just won't work in this new environment and trying something differently. It's just incredible the extent to which that happened across our portfolio. The other thing that surprised us is, we sort of market that our funds should produce great returns in sort of 90% of all macro environments. And, we would have thought prospectively that, a mass pandemic that causes a global economic shutdown might have fallen in that other 10% that might harm our portfolio, where the returns wouldn't be so great. But actually, all of our funds have thrived and have benefited from COVID. And it turns out that our funds are really sort of the long tail of volatility, of this distribution of returns. It really makes no difference whether we have a 30, 40, or 50% failure rate amongst our investments. It's capturing that tail with high certainty. And when you shake up that snow globe and the snow starts to move around a lot at those tails, the more entrenched established companies are the ones that tend to suffer the most and have the toughest time adjusting. And a lot of the smaller companies and more nimble ones can really take advantage. And every single one of our funds had more companies that were harmed than benefited. And every single one of our funds had a small handful that it was like pouring gasoline on a fire, the extent to which their business model was turbocharged by COVID. And they more than made up many times over for the companies that had impaired business models. So it was a great real world test to see how our sort of unique and I would say previously provocative investment strategy would pan out.
Yeah, no, that's great insight as well. And I believe back late last summer, we personally discussed this, but I've always been intrigued at the idea. And I saw some talking about it, but no real families do it. And that is probably a more significant single family office creating an internal, effectively VC arm and doing some of the things that you're talking about, investing in a wide group of companies, knowing that there's going to be, you would hope, some that will make it, many that won't. The ones that make it will make up for it. There's some tax advantages. Do I think a family is necessarily going to get a higher net return than the professionals? Probably not, but they may feel that they have a level of control. They're helping to educate their next gen on businesses and making investments. They may have other reasons than simply my returns are going to be approximately the same than if I had no hassle and I went through a fund. Are you seeing any trends or hearing from larger scale family offices that are creating their own internal VC arms?
Yeah, I think across the board, whether it's in the corporate world or the family office world, there's been a trend over the last decade towards starting to spin up your own private investment arms. I think there's a lot of interest in that all over. I think people are starting to realize that the expected returns are substantially higher there, and we're in a low interest rate world where there's not a lot of investments that produce a lot of returns. And as you said, there's a lot of reasons to do it yourself instead of going through a fund. Even if you think a fund might have higher performance, there's some reasons of control or generational planning or education of the next generation. We certainly, have, most of the investors in our funds are investing for pure financial returns, but we have a handful of investors in each of our funds that are also active direct investors. Some of us use us as deal flow for their later stage investments. Some of them use us because they are just starting up and starting to invest in this earlier stage segment of the tech world. And they want to just have access to be able to pick our brains about the ecosystem anytime they want and get all the insights they get from being one of our LPs. And then they leverage that to do a lot of direct investing outside of what we do.
Well, it is an investment presentation, so I don't want to take the shine off you. We'll have you back and talk more deeply about potentially how family offices could do that. I'm assuming a challenge they're going to have, and part of it's going to be onboarding the right people, paying them. It's going to be getting, when you're starting from nothing, enough deal flow. And that probably is going to need to come from investing in incubators, something similar to you did. Money does talk. Waving the right millions in front of the right incubators could be something that simply gives them opportunity for investments, but we'll save some of that secret sauce for a future dialogue. It's a little bit of a related question, but will be more in your wheelhouse of a GP LP and probably not a great fit for what you do. But I'm assuming, and I have several families that have done this, they approach a VC firm. Usually it's not a huge one. And they basically say, we're very narrowly investing in VC. We have certain thoughts. We want something more customized for us. If we're willing to put enough money in, and that's all relative, would you do a single member LP fund exclusively for us?
Yeah, certainly that's not a problem at all. Again, it just, the unit economics have to work out because it's this entirely separate vehicle that, has its own set of financials, its own cost structure associated with it. But it wouldn't be a problem at all for us to do, essentially a single member fund, and we could tailor our investment strategy to sort of what their specific goals and desires are. I will also say, there are also a number of very unique investment strategies and opportunities that exist off of our portfolio ecosystem. So we have what is essentially proprietary inside information, on this evolving ecosystem of almost 1,000 companies. It'll soon to be 1,000 to 2,000 companies. And we get an incredible number of very interesting debt opportunities each year. There are some very interesting investment strategies that we've lined up that are at later stages, that are investment products that we know there's huge demand for across our ecosystem and just aren't being offered to them. And our general philosophy is the way to get outside returns is not to emulate and do what everyone else is doing. It's to find holes in the market where there's huge demands and needs for capital and to provide products that no one else is providing. And that's when you can generate outsized returns, because as a customer, you're always willing to pay more for the optimal product. You'd always do that rather than pay less for a product that's sticking a square peg in a round hole. And a lot of the investment products offered to startups are products that are designed for what the investors want, and they don't take into consideration a lot what works for the founders. And if you flip that script around, there's a lot of ways to make really huge returns up and down the spectrum in this ecosystem.
And a question came in, how large were funds 1, 2, and 3?
So fund 1 was a $6.5 million proof of concept fund. Fund 2 and 3, fund 3 was sort of like a fund 2.5. It launched very suddenly, unexpectedly for a few reasons, and we only had it open for a handful of months. 2 and 3 combined are a little over 30 million. It's about 33 million. Fund 4, which we just launched, COVID has actually blown up our fundraising a little bit. So we happened to do our first small, just sort of friends and family close right before COVID hit. We were supposed to have our next 2 closes at the beginning of Q2 and 3 last year, which didn't happen. Our fund 4 will likely be a $25 to $50 million fund, where we're at right now. If you had asked me in February of last year, I would have said it would be 50 to 100.
Right. And you're still investing in such a large swath of companies because they're at the stage you're investing in. Some of the checks are small, and that's not necessarily.
We have a lot of flexibility of how much we put in each company. We can, again, for every company we've ever invested in, there's been another 2 to 3 that are equally attractive we haven't invested in. We could have gotten twice as much money into every company we've invested in too. So our challenge has always been capital constrained. We could easily deploy a lot more capital than we have.
Which goes a little bit to the question of a single member LP fund for $1 billion plus family. The numbers that you're talking about your latest fund size, I mean, sure, it's going to get attention, but it's not a huge number for them. Again, I know it's relative.
True. That's completely true. For $1 billion plus family office, we would have some very different value props for them. I mean, to start with, the market we're investing in is so enormous. We could easily deploy 100 million a year into this market and not have warp any of the pricing. Now, I wouldn't start and do that tomorrow, but within 18 months, we could scale up and do that without any problem. But for someone that's a really large family office, what I would say is there's not just potential to deploy a lot of capital into this stage, but like I said, the ecosystem that we create, there are debt products that you can have that can have incredible outsized returns that are much different than any of the other debt products out there. We actually have I didn't address it today. We have a second investment strategy that we've already launched a proof of concept fund for that writes slightly larger checks. It's a completely different product than what traditional VC funds look like, and it is crushing it as well. There's large capacity for that, and we've got a couple other strategies that we've already mocked out that could work at large dollars. So it's easy to create an ecosystem where you're putting out 100 million a month just in this core strategy, and you could be putting out a couple $100 million on top of that in these other strategies. Again, I'm simply pitching for our Fund 4 right now, but that's a much larger conversation that I'd be happy to have. It would be a conversation that plays out over a longer time horizon. And maybe it starts with that investor dipping their toe into our Fund 4 to understand how we work and get to know us better.
Well, this has been fantastic, David. I look forward to having you back on other levels of education that we do in some of our programming in the coming weeks to months. And again, for those that may hear this and not have a chance to see the visual of your contact info, if you can know, if you wanted to, your phone number and for sure your email.
Yeah, so my email is dave@rightside.capital.com. And my direct phone number is 650-465-5619.
Well, Dave, this has been fantastic. Normally, I would do a relatively elaborate close, but because this will be a non-public video, not really, just very simply, I'm Angelo Robles, the host of the Angelo Robles podcast and the founder and CEO at Family Office Association, a global membership organization dedicated to family offices. What I will say in concluding, because we had especially more of an investment presentation, but really anything that covers investing, a reminder, everyone's situation is different. We're really focused on large, very, very investing successful families. That's our core audience and what we focus on in terms of our content. Everyone's goals, their risk tolerance, their timelines, their horizons, all of that, it's completely different. And things also change. You may hear this and rewatch it maybe in one of our private videos a year or 2 years later, and things could change. In any investment, rather bluntly, you could lose all your money. You have to understand that and do your own diligence. David, this has been great. I look forward to the next time.
Yeah, it's been great doing it too. Thanks a lot.
Thank you. Bye-bye.